Welcome to another episode of China Update, where I provide you with the most up-to-date political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Okay, happy Wednesday, everybody. Of course, it is not a happy time for the victims of an earthquake in northwest China this week. According to the local authorities, at least 118 people in Gansu province and neighboring Qinghai have been killed in a 6.2 magnitude earthquake that struck shortly before midnight on Monday this week. The subsequent rescue team has been continuing amid sub-zero temperatures. We remember too that in the north generally, the country is seeing some of its worst cold weather on record. As of Tuesday morning, 105 people from Gansu were confirmed dead, with another almost 400 injured. Qinghai reported 13 deaths and over 180 injuries. General Secretary Xi Jinping called for an all-out search and rescue effort, and the State Council has sent a working group to the area. We now move into the main developments for today's episode. The big news from this week is, of course, the disruptions caused by mounting attacks from Iranian-backed rebels in the Red Sea, causing container ship owners to increasingly abandon one of the world's busiest trading routes. Houthi leaders have said their campaign is in response to Israel's offensive against Hamas. There has been more than 10 attacks on ships in the area since the conflict began. In trading this week, shipping stocks rose as markets anticipate that the disruptions would drive up prices they could charge for moving goods on ocean containers. This was especially the case in East Asia, where economies rely heavily on extra-regional trade. On Monday, Japan's shippers rose as much as 5.8%, South Korea's Korea Line Corp and China's Ningbo Ocean Shipping Co. both gained as much as 10%. The Red Sea sits at the entrance of the Suez Canal, which forms the shortest shipping route between Asia and Europe, making it crucial for trade between the two regions. What is good for these individual companies is not good for economies generally, however, and as we will see, China is especially, though of course not uniquely affected. According to a note from Citigroup Inc., analysts sending container ships between Asia and Europe around South Africa's Cape of Good Hope, instead of through the Suez Canal, would extend journey times by up to 2 weeks. If all trade was rerouted, this would represent an annualized 6% reduction in effective container supply. Chinese financial media outlet Caixin, writing on this development as it relates to China specifically, reports that China COSCO Shipping Corp Limited, the world's 4th largest container shipping company by capacity, will suspend all shipments through the Red Sea. Quote, right now, most shipping companies are still holding a wait-and-see attitude. A long-term suspension of the shipping route would have a significant impact on global trade, an analyst at a securities firm told Caixin. About 30% of the global container trade and about 10% of crude oil trade passes through the Suez Canal every year. China's auto exports could be among the most heavily affected, one analyst previously told Caixin. Even if the charter fee remains the same, the cost of exporting each Chinese car to Europe will increase by 20%. Other costs, such as ship insurance premiums and security costs, will also rise significantly. End quote. Europe is China's most important market for EV exports. Shipping prices between China and Europe have already shot up amid concerns over supply chain disruptions. Quote, the price of the Mediterranean route is soaring now. The freight rate of early January may double that of early December. End quote. This week, in response to this unfolding crisis in the region, the United States announced a 10-nation coalition to quell the attacks in the Red Sea. China is not one of these nations, even though it does have Navy vessels in the region. But it will still benefit if the US-led coalition is successful. A reminder that, despite all its talk of an alternative Sinocentric world order, it remains to be seen whether China is willing and/or able to maintain a global trade system. Indeed, here is one piece of commentary in state media this week. Quote, the Red Sea is truly important for China as it connects Europe, Asia and Africa, so China will pay close attention to the situation. However, although China has naval vessels in the region, their mission is about anti-piracy rather than intervening in regional issues and other countries' internal affairs. Only a solution to the ongoing crisis in Gaza can effectively solve the problem in the Red Sea." End quote. Some argue that this isn't China's issue. Quote, "Houthis are specifically targeting Israel, so it's unlikely it will attack Chinese vessels. China doesn't need to be worried about the situation, and the Chinese warships in the region will stick to their plan." End quote. As we have already seen, however, with China COSCO Shipping Corp's suspension of all shipments through the Red Sea, Chinese container shipping companies themselves, who, unlike this commentator, have to put lives and property on the line, do not share his optimism. Meanwhile, so far there has been no news to suggest Beijing is willing to leverage its relationship with Iran to rein in its Yemeni proxies. Quote, "China will keep making efforts to realize a sustainable ceasefire and clear the way for humanitarian aid to get into the Gaza Strip. This is the real priority that needs to be done." End quote. Next up, the Chinese economy. I hope you're enjoying today's episode. If you're getting some value from this episode, I only have one ask. That is to like and subscribe. And if you really want to go the extra mile, sharing is also a big help. This is the primary way in which this channel grows. The main way it is shown to new people is if the algorithm is happy, and that means likes and subscribes. For anyone who wants to help keep the channel financially sustainable, which allows me to continue doing this every day, open and free for all, Patreon and Buy Me a Coffee links are in the description below. My commitment has been a channel open to all that is reliant primarily on subscriber support rather than corporate sponsorship, and with your assistance, I know I can keep it that way. Thank you so much, everybody, for the ongoing support. Let's continue. We end today with two quick economic updates. Chinese financial media outlet Yicai reports this week that several Chinese cities, including the megacities of Beijing and Shanghai, have issued the first batch of permits for car makers to conduct road tests on vehicles equipped with advanced Level 3 autonomous driving technology, a step toward introducing driverless cars. Regulators granted licenses to test vehicles with self-driving features the German car maker Mercedes-Benz AG, BMW Group, and Alibaba Group-backed IM Motors. Chinese financial media outlet Caixin, writing on the development, explains that the permits will allow the car makers to test drive vehicles on designated areas of highways. Quote, "The completion of the road tests is a precondition for companies joining a pilot program aiming to commercialize driverless cars in the country." End quote. Adding that a number of domestic automakers and electric vehicle startups are also applying for the permit. Electric vehicles and autonomous driving technology are areas which China is pouring massive amounts of resources into, and established international car makers are increasingly concerned that the Chinese may well give them a run for their money. Beijing fits autonomous driving technology into 6 categories, from 0 to 5, with 5 representing fully autonomous. Level 3 technology allows a vehicle to drive itself only in certain conditions. Level 4 technology allows a car to run almost entirely without human intervention. And our last update for today. According to a new report from Shanghai-based consultancy ZBen Advisors Limited, mutual funds, the once preferred investment vehicle for Chinese retail investors, have plummeted in popularity. According to the report's data, the amount of money that mutual funds raised this year has plunged to the lowest levels in a decade. $21 billion worth of new portfolios issued up to end November is about half of last year's total and marks a 3rd consecutive annual drop. US-based Bloomberg, reporting on the numbers, explains that households have been reluctant to take on more risk this year as post-pandemic uncertainties over employment and declining property prices push them to prioritize early mortgage repayments and cash savings. At the same time, quote, "The benchmark CSI 300 index is poised for an unprecedented 3rd year of losses. Foreign funds have sold at levels unseen in the past, and government policies are deemed insufficient or ineffective." End quote. This latter point is particularly relevant, with some commentators calling the stock market situation a catastrophe for household wealth. Though, as we saw earlier this week, it is the reduction in house prices which hurts middle-class wealth the most. Quote, 3 years of losses in stocks are rare even in a global context, and unless there are market returns next year, the only way to address this issue is to improve market confidence. End quote. The Bloomberg article points out, too, that the amount raised is on par with 2014. Quote, during the market doldrums that preceded the 2015 stock crash, but the onshore equity market is now nearly 3 times its size than a single month during more bullish years. End quote. Okay, that is today's episode of China Update. Thank you so much, everybody, for watching. Have a good Wednesday, and I will see you all tomorrow.